chapter 3 today, which chapter 3 is kind of our planning phase of our audit. There's a lot contained within chapter 3. It sets the stage for everything else we're going to be doing. First part of today is we're going to be doing engagement planning. We're going to be doing some strategic assessment. I would encourage you to take detailed notes and diligent notes and ask questions as you have them. Should be obvious the areas that I'm focusing on, but obviously all of it's relevant. But let's get into it. Let's talk about the job here. So it would be wonderful for me to say that basically as an auditor, all you have to do is just show up for work and people will start asking you to do the work for them. But the simple truth is the big four firms that you work for, the public accounting firms, regional firms, whatever firm you might go to work for, they are a business just like any other business, and they need to have clients in order to be able to stay in business. And client acceptance and consideration is one of the very first things, probably the very first thing we need to consider when we talk about whether or not we're going to do an audit. Because as we're going to find out, audit is a procedure that is required or requested by an external party. So they're actually asking us to come in and say, we want you to criticize and critique everything that we're doing. And so, okay, get ready. So we're hired by the client to perform a service, but not all clients are created equal. We need to actually make some decisions about whether or not we want to accept a client. So there's the first scenario we're going to talk about is a very basic scenario. Let's assume that we are looking at taking on a client for the first time. All right. Now, this client may have never received an audit before. This is the first time they actually request a financial statement audit. Or there's a possibility they have been audited previously, but they're wanting to change auditors and they're actually asking you to do the work. So what are some considerations that we have that we need to consider putting in your mind? So first thing is they need to be capable. The firm that's going to be taking on the work needs to be capable of performing the engagement. And we'll talk about the criteria for that. Generally speaking, we want to make sure that we have adequate staffing and personnel and expertise in the area. Now, staffing and personnel is a big one. And we're going to talk a little bit about the nature of that. If you're looking at a client that's a multi-billion-dollar firm, you probably aren't going to be hiring a sole proprietorship here in Kirksville to do the work. That's just not a good alignment of resources. Usually a multi-billion-dollar firm is going to use a big four accounting firm for the resources because they've got all the personnel and that they need and all the expertise. Additionally, there may be some specialized knowledge that's required. So if we're talking about a business that's in a particular line or area, then we want to hire an accounting firm that's got knowledge in that area. Say you're an accounting firm that's only ever done audits of retail shopping companies or retail merchandising firms, and an oil company says, we'd like you to do an audit for us. Has anybody ever done oil and natural gas accounting? I have, and I still don't understand it, okay? I would not be considered an expert in oil and natural gas accounting, even though I worked on it multiple years. It is very, very specific as far as the type of knowledge that's required in that area. So we need to make sure that we have the ability to perform the engagement as such. We also want to make sure we comply with legal, relevant ethical requirements. So oftentimes this is going to go with the nature of the code of professional conduct we talked about. Make sure that we have those independent rules in place. Also, legal rules in place. We want to make sure that we're not providing services we can't provide. This goes very, very much in line with the idea of doing PCAOB work or public company audit work. Usually, if you're working on a public company audit, that's the only thing that you can do for a client. You can't provide any other services. That's not 100% accurate, but it's for the most part it is. Think about public company auditing as basically being a sole engagement. All the other types of engagements need to be done by other accounting firms. And then we also need to consider the integrity of the client. If we're doing an audit, we would like to make sure that the information that's being provided by management is reliable, that we can actually utilize that information effectively. If they're prone to commit fraud, we may say pass, okay, because that will make our job more difficult. All right, so what are some other things that we can consider or some things to consider for the auditor? So let's assume that we have a situation where the client has been audited before, okay? What are some questions that we can ask of the predecessor auditor? What are some things that we need to talk about the predecessor auditor? Well, first of all, we can ask them, tell us about management integrity. Do they tell the truth? Do they lie? What is it we need to know? Secondly, do you have any disagreements with management that we should be aware of? Anything that created problems or contentious issues within the audits that we want to be aware of? Thirdly, communication with corporate governance. Now, we talked about corporate governance on Wednesday. I said that generally speaking, corporate governance is the board of directors of the organization. But for audit perspective, we were more relying on communications with the audit committee. Okay, we're going to talk about the composition of the audit committee. If a client has an audit committee, that is going to be our point of contact for the engagement. All right, at least our high level point of contact. We also want to know the reason for the change in auditor. And that sounds nefarious. Like if they're changing auditor, why are they doing it? If they're trying to get a favorable opinion? Sometimes, yeah. Sometimes, like back in 2010, Overstock.com, they had a big issue where they could not get a clean opinion. So they kept firing auditors and hiring new auditors so they could do it. And eventually they got one, and it was not pretty. It was a very ugly scene in the media. But some reasons for changing auditors make sense. Okay, let's say you're a company like Amazon.com. Okay, I still call them Amazon.com even though they're just Amazon now. All right, was Amazon always a multi-billion-dollar company? No. Does anybody know what their origin is, by the way? What their first business line was?
First business line, really sad.
Oh, yeah, they were textbooks. Okay. In fact, I remember back in 2003 buying textbooks off this startup Amazon. It's like, wow, this is kind of convenient. I wish we could do this more often. All right. So yeah, they were selling textbooks and then other books as well. And then now they sell everything. They own the world. So imagine Amazon's growth model in a 20-year period. Okay. 5 years after they started, they probably are much larger than they were when they first started business. They started out from a $1 million-something company to a $1 billion company, and now a super $1 trillion company or whatever their size is. But they're very large, and they grew very dramatically. Do you think that they're still on their same auditor that they started the business with? Probably not. That first auditor said, yeah, after the first year I was done. So they may be changing just simply because of the nature of the business. Also, we need to know about related parties and unusual transactions. So unusual transactions is pretty intuitive. It speaks for itself. We're going to talk a little bit about related parties here in a little bit. So that is client acceptance. And client acceptance is saying, do we want to do the audit for the first time, yay or nay? In many situations, we're going to be talking about something called client continuance. All right, client continuance is basically a related idea, but this is where we've done the audit in a previous period, and we want to know, do we want to continue on? I'm going to tell you that in 90% of the scenarios, probably a higher number than that, 90 to 100%, well, not 100%, 90 to 99% of the scenarios, the answer is yes. Once we develop all the time and resources and effort learning about a client, it makes sense for us to continue doing work for that client because it's much easier to do the second year and the third year as we learn more about the client moving forward. It would be completely and totally non-intuitive for a client to hire a new auditor every year because they'd have to start from scratch. So that's one of the big advantages about client continuance. But what are some reasons that we want to consider? So first of all, we are going to evaluate client retention periodically, okay? This is usually going to be near the audit completion. So as we're starting to complete our final part of our audit, or after a significant event. Now, what comprises a significant event? An example of this might be a merger or acquisition that changes the structure of the organization, or a divestiture of a significant part of the organization. Anything that might change the nature of the audit moving forward. So we're going to say as auditors, let's consider, do we want to do this auditor again for the next year? Are we going to sign a contract to continue doing the audit with a client? And the answer, like I said, is usually yes. What are some reasons that we might say no? Well, the two primary reasons are going to be conflicts over accounting and auditing issues. We're trying to do our job and the client just makes it really difficult to do our job, okay? So imagine you in a student position. You're trying to do the homework and your professor just makes things more difficult for you. Just keeps assigning homework at the last minute, emails you the last second, says, did I say it was due on Wednesday? It's due tomorrow, okay? You just do all sorts of things. You'd probably be just kind of like, forget it, I quit this class, okay? Which is probably a really bad scenario if you're in a scenario where the situation where the class is required for your major. I'll try not to do that to you, okay? I only bring that up because I just actually did that to you yesterday. So my apologies, my apologies. So yeah, it's if you have a scenario where you've got conflicts with the management team over accounting and auditing issues, there's just a contentious relationship constantly going on. If that's the case, we may say, look, we appreciate the opportunity to do the audit, but we don't want to do it going forward because this is just too much. Okay, find yourself another auditor. The other possibility is dispute over fees. Now, this one seems a little bit more subtle, but consider that usually for really large audits, which will be a focus of this course, there are going to be a lot of people who rely on the work in order to get paid. So even if we're talking about really large accounting firms, they've got to generate the resources they need to pay their employees. So they're going to actually say, this work is worth a certain amount of dollars. And if the client comes back and say, we're not willing to pay that, we'll pay you half of that. that would be a situation is like, it is not worth our time or resources to do this particular audit, simply because we cannot do an effective audit for less than X hours, which translates to Y dollars. So it's basically an intuitive math problem, which we'd like to say that that's something that shouldn't happen, but it does happen quite frequently where we have disputes over fees. And it's simple human nature is that the client does not want to pay out more than they absolutely have to. And we, as the accounting firm that's trying to make a business, want to earn as much money as possible. So that's the argument that's going to be made. So let's go ahead and let's move forward with the notion that we are going to go ahead and start the audit. Okay. And just for context, on Monday, we're going to have a discussion where we are going to make the determination. Should we consider Earthware as a client? Now, Earthware is the company that is used as an example for the textbook. We will have a lot of activities and exercises using Earthware information. We're going to have a lot of working papers, a lot of documentation that we're going to fill out associated with that. They're going to be our example company. Your first task on Monday is you're going to review some documents that I provided for you, some documents that are in the book and some documents that are in Brightspace, and you need to answer the question, are we going to retain Earthware as a client for the year moving forward? And there's some critical evaluation you have to do to be able to answer that question. But we're not going to consider that question now. We're just going to assume that we're going to move forward with this particular client and move forward. So what are some things that we need to do as part of preliminary engagement activities? All right, to start the engagement, some things that we need to consider. So the very first thing is we need to determine the engagement team requirements. At the very basic level, this is going to we're going to actually outline the staffing that we need at all levels, how many people we need actually in the office that's going to comprise the main audit team. This is usually associates and senior associates, maybe a manager, depending on the size of the engagement. We'll also have the management team and the partners who are going to be comprising the engagement. For smaller clients, this may be somewhere between 5 to 8 individuals. For really large clients, this could be 30 or more people. Depending on the size of the client. We also need to consider what is the nature of the work that they're going to be doing. Remember, I talked about expertise in certain areas. If you're working on a specific client, you probably want to bring in staff that's familiar with the accounting done in that area or the industry. Next, we need to ensure compliance with ethical and independence requirements. We just talked about that. That's something that we have to consider as part of client acceptance. So hopefully that's a given, but we do need to scrutinize this a little bit further, especially if we're bringing on new staff. We want to make sure that they actually meet these requirements as before. Now we're going to get into independence requirements and ethical requirements once we get to the code of professional conduct here in a few months. So don't worry too much about that now. Just know that anybody who's on an audit engagement does have to comply with ethical and independence standards within the engagement. So something that's kind of interesting, some things that we would consider as part of that is, does the accounting firm who's going to provide the audit, do they also provide consulting services? If the answer is yes, we may not be eligible to be the auditors, or anybody who's provided consulting services and an engagement in the past may not be able to do that. Another one, it's a really, really subtle one. These are just examples of this. You don't need to worry too much about this, but what would be an example? Let's say that we're continuing on with the client and they have unpaid fees that are over a year old. Can we consider using or consider operating with them as a client or not? The answer is generally no. And the reason why is a really, really subtle one. So think back to 303. When you have a short-term payable that's over a year old, what does it get transitioned to? A long-term payable, okay? A long-term payable, it becomes a note. What's implicit whenever you have a note in an organization? Interest, okay? So if you have an interest-bearing instrument, you are no longer just holding a payable, you are now holding an ownership in an organization. If we own an organization and we're also auditing it, does that seem to violate independence? Yeah, so there are really some really subtle distinctions that we have to make, some things that we have to really consider that may not be immediately obvious in this context. We also need to establish an understanding with the entity, and we're going to talk a lot about this here in just a second. We're going to have examples for all of these. That's going to comprise 3 parts: the engagement letter, using the work of the internal audit function, and the role of the audit committee. All right, so what do we mean by engagement letter? I mean that. Oh, that's beautiful. I love it when that happens. It's always great to see, but it's not the engagement letter. Okay. That's not the engagement letter. It's a lot more boring. It's a lot more boring. So yeah, this is an example of the engagement letter for Earthware Clothiers. This is a little bit older one. I haven't updated the slides with the one from the new version of the book, but the example is pretty much the same. So at its basic level, the engagement letter serves as a contract outlining the responsibilities of both parties. So at basic level, you need to know that the engagement letter is a contract between the client and the auditor that outlines responsibilities. Now, there is a lot of detail in this engagement letter. You'll notice it's 3 pages long. Do I want you to know every single component of the engagement letter? No, I'm not a monster, okay? But I do want you to know some important components of the engagement letter. So let's talk about those. What are the three most important components you need to remember in the engagement letter? Well, the first thing are going to be the responsibilities for both parties. So what is management's responsibility? And what is auditor's responsibility? So manager's responsibility and auditor's responsibility. Now you're going to get sick of me talking about this because I'm going to say this many, many times throughout the semester, okay? But what is management's responsibility with respect to financial statements and internal controls? You should know this already from accounting information systems. Manager responsible for the preparation and presentation of financial statements. They're also responsible for the design, implementation, and maintenance of internal controls. That's what we learned back in AIS, okay? So just throwing that forward, that's what's going to be said in the engagement letter. Is that management, they're the ones who create the financial statements, they're the ones who develop the controls. What is the auditor's responsibility? The auditor is going to be responsible for testing that information, for gaining assurance about management's representations made with respect to the financial statements and internal controls. So that's in a nutshell the difference right there. And that's what's going to be outlined in there. But I said there are three sections. That's two sections. What is the third one? The third one is going to be the objectives of the audit. The objectives of the audit. And that just outlines what's going to happen during the audit. It's going to be kind of a checklist saying, here's what the auditor is going to do. It's not going to be specific, but it's going to be very general as far as like, think about the learning objectives for the syllabus in this course. I didn't tell you what the specific assignments were, but I said, here's what we're going to learn as part of this course. Same old true holds true for the objectives of the audit and the engagement letter. All right, next thing I want to talk about is I want to talk about the internal audit function. Now, we already mentioned internal auditors. We talked about those on Wednesday. They are representatives of the client. They are hired by the client. They work for the client. They're paid by the client, okay? They're the ones who work there day by day to try to improve the quality of information that's developed by the client on a consistent basis. Now, just a rhetorical question, all right? A rhetorical question, but I expect you to answer anyway. Who do you think knows more about the operations of the client on a day-to-day basis? The internal auditor, who's there every single day, or the external auditor, who's there for a few weeks out of the year? The internal auditor, okay? So if they know more about it, then they probably are in a better position to provide some work or detail that shows the true nature of the client. So can we rely on their work? The answer is yes. Contingent upon three factors, okay? We as the external auditors have to evaluate three characteristics of the internal audit function. First of all, we need to know that they are objective, that they do their work without management interference, okay? They have to be objective. Secondly, they have to be competent, okay? It's really, really a big letdown if you rely on somebody's work and they don't know what they're doing, okay? That's happened to me many times in my career, sadly. Not here at Truman State. Pretty much everybody knows what they're doing here. Yeah, okay. And I'm not just throwing that in, it's actual truth. All right, finally, the application of the internal audit function of a systematic and disciplined approach. Does what they're doing make sense? Can we follow it? Can we follow the pattern of the work that they do? If all three of those are applicable, then the good news is we as external auditors can use some of their work to gain assurance. Which, think about that from a logical perspective. If you're an auditor, do you want to do more work or less work? Actually, if you're a human being, do you want to do more work or less work? Anybody want to say more? Okay, I can give you more work. Okay, I got plenty of it. There's a lot of some questions in the textbook I didn't assign. Our assumption is less. And so if we can do less work and get more assurance out of it, then I'm all on board for it. So yeah, these are the three things we need to consider. All three of those have to be in place in order for us to get the base. Now, I do want to make a note. This is actually going to come up with the homework questions. So the PCAOB does consider all three of these to be critical. The Public Company Accounting Oversight Board, the Auditing Standards Board, which is private company audits, they only consider the first two to be necessary. All right. For purposes of this class, you're going to be responsible for knowing all three, even though the question that you're going to see in homework only talks about two because it's talking about a non-issuer audit. But that's a little bit of a subtle distinction there. All right. So for the audit committee, that was the third thing we're going to talk about. We've already talked about this, that this is a subset of the board of directors, a subcommittee of the board of directors. Now, the very first thing I want to make a note of, if we're talking about an audit committee for a private company, for a non-issuer company, there are no composition requirements that need to be noted, okay? Anybody who's on the board of directors can serve on the audit committee. Sometimes in that scenario, we're just happy to have an audit committee. Many organizations that are, especially those that are privately held, don't have audit committees. So having an audit committee is just a boon in and of itself. So for private companies, there's no criteria. For a public company, however, PCAOB guidelines, PCAOB standards, and Sarbanes-Oxley Act specify that there are specific criteria. Okay, Sarbanes-Oxley Section 301 actually says that they has to be comprised of outside independent board members. Okay, and if you're following along in the Sarbanes-Oxley Act, that's actually on page 32 of the Sarbanes-Oxley Act, if you want to reference that. So what does outside independent mean? What does that mean to you? What does that you think that means? Does that mean the management can be on the board or can be on the audit committee in this situation? First of all, can management serve as board of directors? Yes, they can. Okay. Can they serve on the audit committee? They cannot. Okay. They cannot. So it cannot be an organizational individual who's employed by the organization actively. Okay. So it cannot be somebody on the board of directors who's actively employed by the organization, which would make sense because we're doing the work on behalf of the stakeholders, but we're testing the work of management. If management who we're reporting to, eventually who our final report is to, that would really kind of defeat the purpose. Because remember, we're trying to test their work and kind of provide an independent issue. Also, Sarbanes-Oxley Act Section 407, this is page 46 of SOX, specifies that at least one member of the audit committee be a financial expert. Okay, so there has to be at least one person on the audit committee who knows what auditing is all about. How do they define a financial expert, by the way? The answer is that it has to be somebody who has served in a controller or a chief financial officer type role. So basically a financial executive role for a financial statement audit. So somebody who's been a controller or CFO for an organization during a financial statement audit that's taken place. So they need to understand what actually takes place during audits. Now, the good news is it doesn't have to be every single person. I would not qualify as a financial expert, despite the fact that I teach this stuff. Nobody in this room would qualify as a financial expert aside from the fact that you all are very, very smart. It does need to be specifically that role. But it only needs to be one person who actually fits that role. That's kind of the caveat there. It only needs to be one person. So in developing, for planning for the engagement, we're going to actually take two steps. We're going to develop an audit strategy and then follow up with that with a plan. Now, there's a subtle distinction between strategy and plan. It's a little bit like the distinction between strategy and tactics. Anybody play video games where you have to actually kind of set up your strategy and then you have to adjust them as things go on? Like playing those games like League of Legends, like, okay, well, we're gonna have these three people here in the middle lane and the other two are gonna guard the out lanes. And then your opponent just basically starts going all in one lane. It's okay, everybody's got to shift. Everybody's got to shift. Okay. First part's tactics. The second part is, first part's strategy. Second part is tactics. Okay. Okay. And I don't play League of Legends, so I don't know what happens in there, but yeah, that's the idea. It's kind of the idea. So for strategy and plan, the strategy helps the auditor determine what resources are needed to perform the engagement. The plan is more detailed and more fluid. It actually considers how to conduct the engagement in an effective and efficient manner. Now, even though these are going to be separate terms, they are going to be overlapping in some regards. And so we're going to treat them fairly synonymously for the time being. So what are some things that we need to consider as part of audit planning? Okay, that part of the overall strategy, but are specific to the audit plan. Well, first of all, we need to assess business risks. This is going to be really critical in Chapter 4 when we get to that next Friday. We need to understand what are the risks present in the business because this dictates the flow of the audit. If we don't understand risk, we can't actually make good decisions. Then we need to establish materiality. Now, materiality is a nightmare. This is one of those things that everybody is kind of really, really happy when we first start out of it. It's like, this is what I believe accounting to be. This is computation. None of this auditing where we're talking about assertions and talking about how we feel about things. Don't worry that we're going to have plenty of time for that, but everybody's going to be really happy for materiality because you're going to see numbers. Okay. You're going to be like in accounting numbers. Yes, that's what I'm here for. Okay. And then I'm going to start throwing all those numbers at you and talking about how you should calculate them. You're going to be really miserable. So you're going to second guess. You're going to be really happy on Monday, and then you're going to be really sad. Okay. So I'm throwing that at you right now. Be prepared. Be prepared for happiness and sadness all in the same day. All right. Consider multi-locations. Really large organizations, they generally operate worldwide. Most organizations don't have resources to be able to manage all worldwide audits. So if we need to actually test someplace in another country that doesn't have a local office, how are we going to test that? The answer is sometimes it's going to be challenging. We may have to send people out there. We may have to hire a second firm to do the work for us. Whatever it is, we need to be able to understand how we actually plan to develop the audit for really large organizations. Also, we've talked about it multiple times already. We need to assess the need for specialists. Is the organization's business model so much that we need people who are specialized in certain areas? So one thing that comes up really, really heavily is, do we need actuaries? Has anybody done actuarial work? Thought about actuarial work? Anybody developed their own Black-Scholes model? Black-Scholes, yeah, Black-Scholes model. I have not either, so don't feel bad. That's going to require, so information technology is another one of those areas where actually looking at the accounting information system, we need somebody who's actually familiar with that, okay, and can actually delve into the system. Specialists can be very, very diverse in what it is they provide. Consider violation of the laws and regulations. Even though we're only concerned about whether the financial statements or internal controls are good, we want to consider whether or not fraud is taking place and whether or not people are breaking the rules in the organization. We do have an ancillary responsibility for that. We're going to talk about that a little bit more in chapter 4, though. Identify related parties. Hold on to that. We're going to talk about that specifically here in just a second. We also want to consider additional value-added services. Largely, these are going to be very limited in the scope that we can provide, again, especially in public company audits, because we cannot provide that many other services. But being the fact that we're in the position of being the auditor, that gives us a unique insight as an operational organization. So if we can provide value-added services that we can do without violating our independence, then that's going to be beneficial for everyone, because the client will be better off and we'll be better off because we'll earn more money. So that's something we can look at. Also, we want to document the overall audit strategy, audit plan, and prepare audit programs. We're going to talk about those when we get to documentation, because those are all forms of documentation, but we're going to see some examples of those in chapters 3 and chapter 4 as well. I did want to make a note. I always skip this note and I don't know why. So we think of laws and regulations, we should be thinking about the term illegal acts, okay? What is the auditor's responsibility for illegal acts? The auditor has a responsibility to plan and provide reasonable assurance of detecting illegal acts. So we have to provide reasonable assurance of detecting legal acts, but there is a threshold. They have to have a direct and material effect on the financial statements. And this is an important caveat to make. Do we have to provide an audit? Do we have to provide an audit that's going to find every legal act that's going to be conducted by the client? The answer is no. But if they have a direct and a material effect on the financial statements, our audit should be sufficient in scope that it can actually identify those and address those as necessary. So the key terms there is illegal acts, and audit has to be sufficient to identify illegal acts that have a direct and material effect. All right, related party. Have you heard this term before? What's a related party? Anybody with an external business or external relationship to the client, not necessarily business external relationship. Okay, so related party. An example of this would be like if I had a son that was in here in this class. Okay, that would be an example of the nepotism in this class. Okay, so that would actually probably be a nightmare because my expectations would be much higher for a child than it would be for everybody else. But that would be kind of that. If you talk about business operations that occur in family organizations, so say for example, the CEO is giving business to his brother. Would that be a related party transaction? Yes. Okay. Are related party transactions forbidden under generally accepted accounting principles? They are not forbidden. However, under GAAP, if a related party transaction takes place, they need to be disclosed in the financial statements. Okay. What about the auditor? What does the auditor have to do with respect to related party transactions? So related party transactions generally do not occur at something called arm's length. You notice I've got arm's length up there. So think about that. If you're doing business with somebody who's a colleague, but not like a related party, when you basically say that you're going to commence the transaction, you're going to say, okay, we agree to this transaction. How do you show your agreement? Reach out, shake your hand. Okay, that's arm's length right there. Okay. If you agree to something with a close relative, like your mom or your dad, and say, okay, I agree. Do you shake their hand too? I mean, maybe some of you do. That's weird, but yeah, give them a big old hug. Okay. Give them a big old hug. That is closer than arm's length. That is closer than arm's length. We as auditors need to understand the relationships and transactions to understand if if they are taking place at arm's length or if they're closer than arm's length. And we may have to make disclosures if we believe they're occurring at closer than arm's length. At the very nature, related party transactions are not considered to be at arm's length, but we still need to scrutinize them to make sure we understand, and we need to make sure that they're properly disclosed. In some situations, if we believe there's abuse, that the related party transactions are being disclosed, but they're inappropriately being disclosed, we need to step in and say, these transactions are not being properly represented by the organization, which is a violation of generally accepted accounting principles. We're going to talk a lot about related party transactions moving forward, but the idea is we have two responsibilities: to evaluate them and to make sure that they're properly disclosed. So evaluate the nature of the related party transaction disclosed. All right. So moving forward, I already talked about on Monday, we're going to talk about materiality. We're also going to do our client accepted engagement exercise as part of our discussion. So you do have a little bit of work over the weekend to prepare for. But chapter 4, we're going to talk about risk assessment. That's where we evaluate those business risks we just talked about. Then we're going to move on to chapter 5. We're going to talk about substantive procedures. We're going to talk about how we gather evidence and what we're going to be doing for the course of the audit. We're also going to be talking about test of controls, but we're going to save the majority of the bulk of that talk of test of controls for chapter 6, which is going to take place after the first exam. So it's going to be a little bit weird because test of controls sequentially in an audit generally takes place before substantive procedures. We'll see why that's the case in chapter 4. But we're going to defer our discussion of test of controls until chapter 6, simply because it makes more sense to do so. It's also important to note that we can actually achieve two birds, one stone type of test. These are called dual purpose tests, which give us assurance for both test of controls and substantive procedures. That's not going to make a lot of sense right now as to what the difference between those two procedures are. I will say that we do have a little bit of a clue right now because one focuses very heavy on transaction events. Another one focuses very heavily on account balances. But we'll get a little more detail about what the difference between test of controls and substantive procedures are when we get to chapter 4 and we can actually see the nature of the audit risk model. Okay. With that, we're done with this part of the discussion of chapter 3, but we still have some homework to talk about. So let's go ahead and get into that. By the way, I apologize for the weirdness on this. This is very, very strange. They've got the question in one small font and then the answers in a larger font, which is bizarre to me. I don't know why they do that, and I can't fix that to any way, shape, or form. This is a new feature for that. The interface is really, really messy, and I'd say I'd go complain to McGraw-Hill, but I already do that a lot. So, all right. So, I'm on chapter 2. Let's go to chapter 1. Chapter 1 says, make that a little bit larger. An independent audit adds value to the communication of financial information because the audit does what? So let's go ahead and look at A. Confirms the exact accuracy of management's financial representations. Be very careful of absolutes. Very careful. Absolute statements are very rarely correct with respect to audit. Okay, remember we talked about that reasonable assurance guideline. Okay, so let's go ahead and look at C. Guarantees the financial statement of data or financial data are fairly presented. That's another absolute. Assures the readers of financial statements that any fraudulent activity has been corrected. That might be something that we would like to accomplish in the course of the audit, but again, keep in mind that illegal acts have to have a direct and material effect. And that's not the total objective of the audit. Remember, the objective of the audit is to focus on the financial statements and provide credibility for them. So anybody who looks at the financial statement says, oh, I believe they're correct because the auditor says they're correct. So that's going to be B. Question 14. Which of the following best describes the reason why an independent auditor is often retained to report on financial statements? So I'm going to shorten this one down because we don't have a lot of time and I want to make sure we get through all the questions. Keep in mind that we've got the principal agent problem, okay? And that is a conflict of interest. That is the crux of the reason for auditors, is that conflicting interests exist between management and the owners of the organization. We're trying to align those interests, so that's B. Different interests may exist between the entity preparing the statement and the person using the statements. Thus, outside assurance is needed to enhance the credibility of the statements. All right, question 15. Which of the following best describes the relationship between auditing and attest and assurance services? Now, I didn't really talk about this in detail, but you could go back to the ovals that were presented in the PowerPoint slides. Assurance is the big oval, okay? That's the largest category. Within that are attest functions, okay? And then audit is very specific in the middle. So that's what you're looking for, which that's going to be C. Auditing is a type of assurance service. All right. This is me as a big goober who's taught auditing for way too long, and I get to laugh at something that nobody else finds funny. So which of the following best describes the way materiality is related to audit evidence in a financial statement audit? Materiality refers to the material from which the audit evidence is developed. Okay. That always makes me giggle. By the time we're done with this course, it'll make you laugh too, or it'll make you cry, one of the two. I'm not sure which. So it's not one of those two. It's actually C or D. Okay. It's actually C or D. So actually, sorry, it's a, so B or C, my apologies, B or C. So it's a higher level which the auditor assesses materiality, the greater evidence, or the lower level assess materiality, the greater evidence, okay? So the question is, are we concerned about gathering evidence of materiality as larger or smaller? Well, keep in mind that when we're looking at auditing, we're looking at misstatements, okay? And if we've got a really, really large amount of materiality, how big can our misstatements be before we start getting concerned? Massive, okay? So we don't have to actually do much testing at all because we've got a big threshold for testing. So when the materiality gets smaller, then we have to scrutinize a lot more because we're really concerned about smaller errors, so we have to do a lot more work. So there's an inverse relationship between materiality and the work that we have to do. And it's going to be something consistent that we hold moving forward. All right, question 21. Which of the following statements best describes what is meant? Yes.
Correct.
C, yeah, I apologize. Yes, C is correct, yeah. Which of the following statements best describe what is meant by an unqualified opinion? Another one where I'm going to laugh. An unqualified, if it says B, unqualified auditor's opinion indicate the auditor is not qualified to express an opinion on the client's financial. That's not the correct answer. That just makes me laugh again. Okay. So what do we say an unqualified opinion was? What do we say? What was the word that I used to describe that? Clean. Okay. It's a clean opinion. That means that we don't have to make any changes, that we are happy with what the audit client has done. So that's what we're looking for an answer. So in this particular case for 21, it says, an unqualified audit opinion indicates the auditor's opinion with the financial statements are fairly presented in accordance with agreed upon criteria. No need for the inclusion of qualified phrases. Okay. Now, they say this agreed upon criteria. If we're talking about public company audits, what is the name for the agreed upon criteria that we're talking about there? It's going to be one that we allude to quite a bit in this course, one that you should be familiar with because you've done this all during financial accounting. So it's got 4 letters. Sounds like a store chain that's at the mall. Yeah, that's what it is. Okay, that's our agreed upon criteria for most financial accounting scenarios. Does that mean that that's the only agreed upon criteria we could work on? No, not necessarily. If we're talking about a private company audit, a lot of organizations use cash or tax basis of accounting. That's something we could report on, but for the most part, we're going to assume GAAP for most of the scenarios in this course. All right. 123. Client has used an inappropriate method accounting for its pension liability on the balance sheet. The resulting misstatement is material, but the auditor does not consider its effect to be pervasive. The auditor cannot convince the client to alter its accounting treatment. The rest of the financial statements are presented in fairly in auditor's opinion. What kind of audit report should be issued under the circumstances? So do we have a clean opinion here? No, there is a material misstatement, but it is not pervasive. So it's not severe enough to result in the extreme opinion, so it must be right in the middle. What do we call that? Qualified, and it tells you specifically qualified opinion to departure from GAAP. They did not follow the rules, so we're going to issue a qualified opinion. Now, this is different from a qualified opinion due to a scope limitation. That would be saying that we could not do our job effectively, so we cannot actually determine if the financial statements are materially misstated in this area. Okay, this one we know 100% that there's a misstatement because they're not following GAAP. We could actually apply a method of GAAP that's applicable and calculate the difference. So we know there's a material misstatement. We actually can calculate that. Let's move on to chapter 2, multiple choice. So 219. Which of the following statements best describe management's and the external auditor's responsibilities, a respective level of responsibility for a company's financial statements? So what do we say? Management's responsible for what? They're responsible for the presentation and preparation of financial statements. Auditors are responsible for testing those, okay? Which of these answers best represents that? Management has a primary responsibility to ensure the company provides financial statements that are prepared in accordance with GAAP. Is that correct? Yeah. And the auditor provides reasonable assurance the statements are free from material misstatement. Okay, so C seems like be our best answer in that situation. Again, responsibility will be very emphasized in this course. So you do need to have a very strong understanding of what management's responsibility is and auditor's responsibility. Hopefully I will repeat it enough times that you'll get sick of it. But if you're sick of me repeating something in the class, that means that you know it, okay? So you should feel good about being sick, okay? At least in this course, 221, the Public Company Accounting Oversight Board. What do we say? So PCAOB, they're responsible for oversight of governmental audits. I mentioned that they're a subset of another a governmental organization. Does anybody remember which one I said they were a subset of? The SEC. Yeah, they're a subset of the SEC. So they were created by the Sarbanes-Oxley Act. They are a quasi-governmental organization that has legal authority to set auditing standards for audits of public companies. That's those last two words are the most important ones. They do auditing standards for public companies. Now, what do we say the body was that does it for non-issuer or for private companies? That is the Auditing Standards Board, which is a subset of the AICPA. Okay. We're going to focus very heavily on PCAOB companies or PCAOB standards. There are differences in the standards, but the differences are generally so minimal that if you learn one set of standards, you learn the majority of the other set of standards. Okay. So, and since I assume that if most of you go into audit, you'll be doing large client audits anyway, this is probably a good approach for us to start. Okay. It's not complete, but it's close to complete. All right. Last question for the day. Problem 125. You were recently hired by the CPA firm Hansen and Hansen. Before you start working, the firm requires you to participate in first-year staff training course. By the way, if you actually are required to do first-year staff training, please make sure that you do it diligently. A Big Four accounting firm, whose name is only two letters, but I'm not going to repeat what their name is, okay? They got into a lot of trouble because they were having people bypass their training. I don't think it was first-year training. They had a lot of people who were with the firm a long time and say, this is a waste of time. So they actually got answers from other associates, and that was kind of problems because the training was required for compliance with PCOB regulations, and they found out about it, and they got into a lot of trouble and were fined a whole lot of money. So if you do the training, it may seem like a waste of time, but please do it because that way you keep your company out of trouble and you keep yourself out of trouble. All right. That should go without saying, don't cheat. Okay. I should probably preface that, but just don't cheat. All right, so the instructor asked you to provide answers for the following questions. All right, so how is audit evidence defined? We defined that a little bit earlier on. So what is the nature of evidence? Well, it takes two forms generally. It can be accounting records, and it can be accounting evidence that's externally gathered or from other sources. But that is kind of a misnomer because we're talking about what is the purpose of gathering evidence. What does it go back to? Okay. Well, let's go ahead and move on to chat or to B because this is going to relate to our answer to part A. Okay. How does audit evidence relate to management assertions? Remember, we talked about management assertions, and did I say that they're important or not important? They are probably the most important thing in this entire course. That's what I said. Okay. So by definition, important. Okay. What do we do when we see management assertions? We say that the financial statements and internal controls are being represented by assertions or by basically by representations that management makes. These are the management assertions. And we as a have responsibility for testing that these assertions are in place. Now, the example that I gave on Wednesday was pretty straightforward. There's a line item that represents inventory. By presenting that line item in the financial statements, that inventory is implicitly visible. We can actually see it and see that it exists, okay? And that it's properly valued, that they're using a method of accounting that's been approved by generally accepted accounting principles, and we can replicate that value, okay? So we have two assertions that we've identified that are critical to inventory. Do we need to test those assertions as auditors? Yes, we do. That's basically what we do. We test things as auditors, okay? So we're going to test assertions as auditors. What do we do to test those assertions? We gather evidence related to those assertions. So say, for example, that you are concerned about the existence assertion of inventory because inventory has exist. Because they could say, we got $5 million of inventory and they've got a warehouse that's completely empty. How can you validate that that's not occurring, that they don't have a warehouse that's completely empty? Walk up to the warehouse and count the inventory. So, okay, they said they have 500 inventory items. 1, 2, 3, 4, 5. Yeah, good. Okay. That's 5. Sorry, 500. 1, 2, 3, 4, 5, 6, 7. No, sorry. I won't do that to you. So yeah, you can count the inventory items and can validate that the representation they made with the existence is correct. What about the valuation? Can you verify valuation? Say, well, I know the 500 inventory items. They say it's $5 million. If I do the math, that's going to be $10,000 worth of inventory item. What did they buy it at? Let me see the invoice. They bought it at $10,000. That valuation seems appropriate to me. We're gathering information, and it's through many different categories of evidence that we can actually gather to test that to make sure everything's correct. So it says, what are two characteristics of audit evidence the auditor must consider when evaluating the quality of evidence, and describe the meaning of these characteristics in the context of auditing? These should sound fairly familiar. Auditing is kind of not updated to GAAP, okay, or FASB, but the terms that they use in the book are relevance and reliability, which we didn't talk about in the lecture, but that's what the book refers to. Relevance and reliability. The reason that these are used is because they relate very closely to the concepts of relevance and faithful representation for accounting information. The large part of the work that we're going to be doing is based on generation of information from our clients, so it makes sense that we're going to treat the information the same way we would treat accounting information as we do for auditing. Okay, relevance is the exact same term. We use the exact same term. Reliability is a big part of faithful representation. In fact, a little bit of note, FASB did not call it faithful representation until I believe it was early 2000s. It was actually still relevance and reliability for FASB, as well as the or as well as, well, I'll say PCOB, but the AICPA for auditing. So they were exactly synonymous terms. FASB only changed that within the past 25 years, which seems like a long time to you all. Seems like an eye blink of time to me. Yeah. So what do these thoughts mean? Well, we want to make sure evidence has these characteristics, these qualities, in order to make sure that we can use it for purposes of gaining assurance. All right. Well done, everyone. Have a good weekend, and I will see you all on Monday.